Have you ever wondered what stocks really are? You hear people talk about them on the news, in movies, or friends always say, "I bought some shares today." But what does it actually mean? By the end of this video, you'll understand stocks completely, what they are, how they work, and why they matter for building wealth. What is a stock? A stock is essentially a piece of ownership in a company. Think of a company as a big pie. When you buy a stock, you're buying a slice of that pie. That slice represents your share of ownership. For example, imagine a small pizza shop worth $1,000. The owner divides it into 100 equal pieces. Each piece is worth $10. If you buy one piece, you now own 1% of the pizza shop. You are officially a part owner. Owning stock means you can benefit if the company grows, but you also share in its risks. If the pizza shop makes more money, your slice becomes more valuable. If it struggles, your slice loses value. So, owning a stock is like having a stake in the company's future. You win when the company wins. Why companies sell stocks? Companies sell stocks to raise money without borrowing from banks. Instead of taking a loan, they offer pieces of ownership to investors. The money they raise can be used to expand, launch new products, hire more employees, or improve operations. Investors like you get a chance to earn returns if the company grows. It's a win-win situation. Why stock prices change? Stock prices aren't fixed. They go up and down based on supply, demand, and how people feel about the company. If a company is profitable, expanding, or launching something exciting, more people want to buy its stock, which pushes the price higher. If the company faces problems, loses money, or has uncertain future prospects, fewer people want it, and the price drops. Basically, the value of your slice of the pie changes with the company's performance and market sentiment. How you make money with stocks. There are two main ways to earn from stocks. Capital gains. This happens when you buy a stock at one price and sell it later at a higher price. For example, you buy a slice of our pizza shop for $10 and the company grows. Later, the slice is worth $15. That's a $5 profit. Dividends. Some companies share a portion of their profits with shareholders. This is paid as cash or additional shares. For example, if the pizza shop earns profits, it might give you $1 per year for each slice you own. Combining these two strategies, stocks can help grow wealth steadily over time. Risks of stocks. But stocks aren't risk-free. Prices can fall and companies can fail. Some investors lose money if they pick the wrong stock or panic during market dips. That's why diversification is key. Spreading your investment across many companies instead of putting all your money into one stock reduces risk. Also, investing with a long-term mindset usually works best. Short-term swings happen every day, but over time, stocks generally trend upward if the companies are solid. Let's say you invested $100 in a company like Apple 10 years ago. Even if the price fluctuated year to year, that $100 would have grown significantly today because Apple expanded globally, sold more products, and increased its profits. Stocks let ordinary people participate in a company's growth and potentially earn from it without owning or running the business themselves. So to recap, stocks are pieces of ownership in companies. Their prices go up and down based on performance and demand. You can make money through capital gains and dividends, but there are risks, which you manage through research and diversification. If you enjoyed this breakdown, hit the like button, comment "I'm ready to learn stocks," and subscribe to Finance Talkin' for more simple and practical finance tips. Remember, understanding stocks is the first step toward building financial freedom, and it starts with just one small investment.